Destiny Settlement Solutions is the key to home ownership. And when it comes to loan closing, commercial or residential, purchase or refinance, you have a choice. Destiny Settlement Solutions will settle any transaction anywhere, 24/7, 365 days a year. It can also help you with deed and note preparation, contract review, ground rent buyout, document preparation, incorporation and LLC setup, and estate and divorce deed issues. Call Destiny Settlement Solutions today at 443-738-2117 or online at destinysettlements.com and settle your next transaction with confidence.
Good morning and welcome to Money Morning. My name's Eric Stewart.
And I'm Paul Robinson.
Today, we're going to be talking to Andy Bauer. He's from the Federal Reserve Bank of Richmond, and he's going to be helping us to get to the bottom of all this stuff that's going on in the economy. So many consumers watch television and listen to the radio, read the newspapers, and go on the internet every day to just hear more and more bad news. None of the good news seems to get reported as often. And, you know, as an investor, as a consumer, as a homeowner, you really, just from a general public standpoint, don't get a clear understanding of what impact these things are having on your day-to-day life. Now, everyone knows it seems like your belt straps are getting tighter. Your wallet seems to, be thinning out, but why are these things taking place, and what can you do to forecast these things, to make adjustments in your monthly budgets, in your yearly budgets, to make sure that you're maximizing your dollar in these tough times? So today we're going to be talking with Andy. Andy, welcome to the show.
Hi, thank you.
Glad to have you.
It's good to be here.
Now, you're from the Federal Reserve Bank of Richmond. How does that relate to the Federal Reserve Board?
Okay, well, basically, the Federal Reserve System, you have the Board of Governors, which is in Washington, D.C., and that's where the chairman is. The chairman is currently Ben Bernanke. Previously, it was Alan Greenspan. And then you have the 12 regional banks, and we're in Maryland. Maryland's part of the 5th District, and that's the district of the Federal Reserve Bank of Richmond. In Washington, D.C., the Board of Governors is actually it's a federal agency. Mm-hmm. Most people think that the Federal Reserve is actually a government institution. I actually work, the Federal Reserve Bank of Richmond is actually private, and so it's part public and part private.
So for this region, what do you guys control, and where does it come into a consumer direct phase? I mean, what you do, how does it affect consumers on a day-to-day?
The Federal Reserve is responsible for a number of things. Most people know that we operate monetary policy. Mm-hmm. And that happens in Washington, D.C., and it's done by the Federal Open Market Committee, the FOMC. The FOMC is the 7 members of the Board of Governors and 4 regional bank presidents, as well as the Federal Reserve Bank president of New York. And they decide interest rates. And so depending on the current state of the economy, they're either going to lower, raise, or keep interest rates the same. And that affects consumers.
How does it affect consumers? Because so many consumers here, they're going to lower interest rate, they're lowering interest rates are lower. What does that mean for me on a day-to-day basis?
Well, it all depends. It all depends on the broader context of what's going on in the economy. So currently, we're concerned about economic weakness. Mm-hmm. We see that the housing market continues to deteriorate. It's broadening into other sectors. As you mentioned, energy prices are higher. Food prices are higher.
Yes, consumers are feeling the pinch.
Consumers are definitely feeling the pinch, and so what we're concerned about is weaker economic growth. And so what we do is we lower interest rates. Mm-hmm. And in the process, that makes the cost of borrowing money for consumers to buy cars, to buy homes, for businesses if they want to go out and make a capital purchase for some sort of investment project, it lowers the cost of funds. It'll increase demand for goods and services in the economy and should help the economy grow.
So you're a regional economist with the Bank of Richmond, Federal
Yes.
Reserve Bank of Richmond. What region do you cover, and what are you seeing in that particular region?
Yeah, so the 5th District is Maryland and Virginia, the Carolinas, as well as parts of West Virginia. I'm in the Baltimore office, so I'm mostly focused on what's going on in Maryland and the greater D.C. area.
Okay.
Now, Maryland's a little bit different than the national economy. We see general weakness in the national economy, but because of Maryland's proximity to the federal government, we got so many federal jobs. Maryland's doing a little bit better than the overall economy. At the same time, though, the housing market in Maryland is probably doing a little bit worse than on average for the U.S.
Now, by worse, you mean, what are you talking about? Appreciation? Are you talking about foreclosures?
Well, what we see is just nationally, wherever you saw, and these are mostly urban areas, where you had large increases in home prices. Those are where the trouble is where we're currently seeing trouble. And
How come? Why?
Why? Well, there's a lot of different narratives as to what the cause of the problem is. A lot of people focused on resets and people being steered into adjustable rate mortgages, and the mortgages were resetting and they couldn't afford them. But really, if you look at the data and some of the studies, it seems that the people that bought at the end of the boom, 2006 and 2007, they bought at the height of the market when homes were most expensive. Incomes didn't increase as fast as home prices, so a lot of people...
Say that again, because so many consumers don't understand the connection between income levels and employment levels and inflation rates and housing prices. How do they relate? And let's hear from an expert.
Well, I mean, generally, there's been a pretty stable relationship between median income and median home prices. And then in the housing boom, because there's just such an increase in home sales and housing prices, we've seen that we've deviated pretty strongly from that relationship. Home prices just increased much faster than income did. And as a result, people stretched, in 2006, 2007, people were stretching to buy into these homes.
And we saw great appreciation in Maryland. Now we're seeing, and you pointed it out exactly, that a lot of people towards the end or in the middle of 2006, 2007, bought at the top of the market. They used very aggressive products to get into those homes. Now, when it comes time to get out of that mortgage that we're in, the home prices have gone down and they're not able to refinance. We talk about it all the time on the show.
Let's talk about how are people being helped now and other things that people can do to kind of forecast staying out of this kind of trouble in the future when we come back from the break. We'll be back right after the break. My name's Eric Stewart.
And I'm Paul Robinson.
We'll see you in a minute here on Money Morning.